So, Hank Green made an astute observation about corporate finance, and he pointed out a problem that people should be paying more attention to. He tweeted, in 2015, U.S. companies spent more than 100% of their earnings inflating their stock prices through dividends and stock buybacks. And I should probably add that even though we're just getting 2016 corporate annual reports coming out now, that situation pretty much is going to repeat last year. And this isn't just a US thing. We also have the same problem in Europe, and we have the same situation in Asia. So we're talking about a worldwide phenomenon here. So of course, Hank only had 140 characters to put this in, so I thought I'd try to explain why this happens and why you should be concerned about it. So I had a little bit of trouble putting this video together because it's a really big subject to tackle, and I didn't really know where to start. Corporate finance is really complicated, and I can spend hours talking about it, though on the other hand it's a little tedious, so you probably don't want me to spend hours talking about it. So I'm trying to synthesize this, get it as short as possible. And I might skip over something, or might do something a little bit too quick or too simple or something like that. So please let me know down in the comments any improvement I can make if you have any questions, or if I missed something, whatever. I might have to do another video. I don't know, you let me know. Anyway, I'm wasting time in explanations here. So dividends. Normally dividends are expected to be going up. So if you see dividends rising, that is actually a good thing, because if a company is financially healthy, it is providing a product or service that a lot of people want. There are going to be more people buying it. The company is going to be making more profit, and more profit means that there's more money available to distribute to the owners or the stockholders, shareholders, pretty much the same thing. That means the distribution of money to the stockholders is called a dividend, and that means the dividend is going to go up. If the dividend goes up, that means the investment in the company is worth more because they're paying you back more money, which means the stock value goes up. That's how things are pretty much supposed to work. Another thing that people are not so much aware of are stock buybacks, which is something that companies also do kind of regularly. It's a normal thing. There's lots of reasons why a company might do a stock buyback. Often it has to do with a too many cooks situation. If you have a lot of investors, they all want to be poking into the business, and it's better sometimes to buy some of them out. And if the company is making a lot of money, it has money available, it can buy one of the investors. Maybe one of the investors got involved when the company was just starting out, and he wants to move on to start another company. So he can, the company will buy his stock. And also this has the effect of reducing the total number of shares that are in the market. So if you have less shares in the market, that means there's less shares on which you're going to divide the profit of the company. So that means also the dividend should be going up, and that means if the dividend is going up, the stock price is also going to go up. Now, a point about the dividend. You see, normally you would expect for companies to raise their dividend when their profits go up, but in reality companies tend to be a little bit reticent about raising their dividend because, well, for a lot of reasons, but you can summarize it basically: if the dividend is going up, that means that the company is doing well and the company is healthy. But if the company has to cut its dividend, that means there's something wrong with the company and the stock price can go down. So that's why a lot of companies tend to be rather slow when it comes to raising their dividend until they're absolutely sure that they won't have to cut it in the near future. So that's how things are normally supposed to work. But if you'll notice that I said that the companies do these buybacks and they raise their dividend as a way of distributing the money that the company makes. So their earnings are distributed to the owners and through buybacks and through dividends. But if we go back to Hank's tweet where he said, companies spend more than 100% of their earnings. Well, if the company is taking out more money out of the company than the company has to give to the owners, to the stockholders, where's that extra money coming from? Well, it's borrowed. And this can be kind of a good thing or kind of a bad thing depending on the financial creativity of the people that are doing it. So where you get this phenomenon is when you have low interest rates. And when you have really, really low interest rates like we do now, it ends up being cheaper for the company to borrow money than it is for the company to issue stock. And that's not how things normally are supposed to be. It's supposed to be the other way around. And this can be a problem, but that is a video for another time. Anyway, let's say, for example, you have a company that has a dividend that yields 4%. That means for every dollar of market value that the company has, it has to pay 4 cents in a dividend. But if the company can borrow money at a very low interest rate of 1% or 0%, like if it's a big company and it has a good financial standing, it can get really cheap loans. For example, in Germany right now, there are companies that can borrow money at negative interest rates. I mean, that means people will literally pay the company to take their money. That's how low the interest rates are. And then, like I said, that's kind of a problem. So, given this situation, what a company can do, typically it's a really big company that's going to do this, they'll borrow money at a lower interest rate to pay off dividend, to buy back stock in which they pay a higher dividend. So let's say, for example, a really big company, $100 million. They're going to borrow $100 million at 1% interest rate, just to make the calculation simple and explain it. So $100 million, interest rate of 1%, that means at the end of the year they're going to have to pay $1 million in interest for that loan. But they take that $100 million and they buy $100 million worth of stock on which they would have had to pay $4 million in dividend. So minus the $1 million that they have to pay for the loan, they end up saving $3 million. So this situation works out great for, well, I mean, everyone's really happy as long as the situation remains the same. You know, the bank's happy, it's getting a loan, the owners are happy, they're making money, and well, you get a bonus, and your customers and your employees are happy because you have more liquidity. But you have to remember that you just did a stock buyback, and the consequence of a stock buyback is almost always that the stock price is going to go up. However, the net asset value of your company actually went down because you took on more debt. So this leads to sort of disparity in terms of the actual value of the company, which goes down, and the price of the stock, which goes up. Now, as long as everything remains the same, we're kind of okay here, and the company's making money. But things don't always remain all nice and warm and fuzzy, and something can happen. You know, a rival company could come out with a new product that takes away your customers, and you will be under significantly more financial duress, and you might not be able to handle that as well. Or your stock price might start going down. That will also have an impact on the valuations of your company, and that will put you in trouble. But if it's just one company, it's not such a big problem as far as society is concerned, because there's lots of other companies and they will sort of mitigate the effect. But if it's something that affects a lot of companies who are doing this, a bigger problem is when interest rates start going up. If interest rates go up enough, then it's no longer profitable for the company to borrow money in order to buy its own stock. And so they're going to, well, stop doing that. If a lot of companies start doing this, what happens is they're no longer, if they're not doing stock buybacks, then they're not propping up the price of their stock. So this can have an overall effect on the market where stock just sort of goes flat or starts to go down. And by not buying as much of their own stock, that has an impact on liquidity. It lowers liquidity, and a lower liquidity is usually what precedes a stock crash. Another problem is if the companies are no longer borrowing money and they're no longer spending that money on buying stock, for example, you have a slowdown of the movement of money and a slower monetary circulation. If it slows down enough, that's what we call a recession. Now, I'm not trying to scare you right now, because this is something that's been going on for quite a while, and there's nothing here saying that it's suddenly going to be a problem right now. But it could be a problem in the future, and it should be something you probably pay attention to, especially if you're one of the people that owns some kind of stock. For example, if you have a 401k, or you have mutual funds, or you have some kind of indexed fund where you're saving up for retirement, or you're saving up, say, for your kids' college, you probably should be paying attention to this and know which of the companies that you're invested in have been doing been buying stock on borrowed money. So I guess that probably explains this phenomenon as kind of succinctly as possible. If you found this interesting, or you curious about more financial stuff, you know, you can click here. It should be a little roundy thing that'll let you subscribe. I'm not going to always do financial stuff. I'm going to try and put some more fun things in it in between. But hopefully you found this interesting and helpful, and have a good one.